everybody. Good afternoon. Welcome to today's webinar, 3 techniques to help you capture the trades of a lifetime. My name is Jerry D'Ambrosio. Hope everybody's doing well. I do want to do a quick sound check before I officially dive in, just to make sure everybody can hear me okay. I want to thank everybody joining me via YouTube as well. So we got YouTube folks, we got folks joining us via GoToMeeting. So just want to do a quick sound check. If you are using GoToMeeting, just type in the chat box. Just let me know that you guys can hear me okay. And that I'm not talking to myself. There we go. BJ says yes, okay. Ryan says hi. Joe says yes. John says yes. Awesome. Well, welcome everybody. Glad you guys could take some time out of your day. It's Friday. Hope everybody's ready for a good weekend. Again, my name is Jerry D'Ambrosio. I'm the manager of educational content with VectorVest. This is our education team. I've been with the company now 16 years. When I first started, our education really solely consisted of the VectorVest program, right? We made sure we spent most, if not all, our time focusing on every in and out, every feature, every tool of the VectorVest system, understanding the VectorVest system of stock analysis, market timing, and that's really all it was. We've evolved over the years, and now we're starting to teach trading techniques, options, retirement portfolio management, things like that. So really proud of our education team. We've come a long way, but that's what we're here today to talk about. So what I'm going to teach you guys are just a few different technical analysis strategies. Technical analysis can help you anticipate what is likely to happen in the future. So it's, nothing in this game is 100%. And notice that I don't say predict what is going to happen in the future, right? It's not about predicting. It's about anticipating changes in trend. It's about identifying reversals. A lot of that stuff is hard to do with the naked eye. And that's what technical indicators are for. They help us understand, make better sense of price action in a way that we just can't unless you're really, really good at reading price charts alone. It's hard to identify changes in trend, weakening trends, just solely by looking at price. That's just an example. I think this is going to help. So if you guys stick with me to the end, I will share with you a copy of today's slides. Okay? Somebody remind me, we're going to be together for about an hour. So right around 2:50 p.m. Eastern time, just somebody remind me and say, hey, Jerry, don't forget the slides, and I'm going to put them in the GoToMeeting handout section. And if you are joining us via YouTube, you'll get them as well. I will send them to the appropriate people, and they will get those out to you as well. You got to stick with me to the end, though. Okay? Sound good? Fair deal? All right. Do you ever feel like trading in the market is like gambling at a casino, right? You feel like it's a crapshoot. The market goes up, the market goes down. You get caught on the wrong side sometimes. You're late to the party sometimes, right? I know that happens, especially in volatile markets, sideways moving markets. The sideways moving market for the average investor is tough. Market's really not going anywhere. It could be months and months and months at a time, and your investments aren't really making you money. But technical analysis is a good alternative in those types of markets. So you feel like trading, swing trading, using technical analysis is a crapshoot. Maybe you just don't have all the knowledge. You're working at it, right? But you don't know all the indicators, and you don't need to know all the technical indicators out there. If you work on a few, if you apply kind of the approach that I'm going to teach you guys here today, it's going to help you tremendously to get started, to start making money using technical indicators in a way that you weren't before. Yes, I'm going to give you the slides, Raj, at the end of our presentation today. Okay, just stick with me to the end. Okay, so you start to learn all these technical indicators, right? But now you feel like you have to look at chart after chart. Chart after chart after chart. And don't get me wrong, I'm a chart reader. I love looking at charts. I like other ways. There are faster ways to get to a handful sometimes of trading candidates. There are faster ways. There's the one-by-one method here where you're just looking at charts. I don't mind that. And I'll do that after I've kind of reduced my large list of candidates to sometimes just a few. I don't mind looking at the charts that way. All right. If you continue to struggle with some of these things, so you're continuing to struggle with, I got to learn all the indicators. I got to throw 5 indicators on my chart. I got to put 4 different types of moving averages. That's the only way I'm going to get good signals, right? No. The more indicators you put on a chart, sometimes the more the confusion it causes. You get redundant signals. You get conflicting signals. It just depends on the indicator. So, you don't want to lead. You don't want all of this, your endeavor here, to lead to confusion or frustration. So what we want to do is we want to put probability on our side. We don't want it to be a crapshoot anymore. Okay, we're not going to know everything, about every indicator out there, but you're gonna learn a few. And really, the most important part of it is the market, and we're going to talk about that. So we want to put probability on our side, and we want to know what we're doing. Okay, we want to understand the indicators and how to follow the indicators, and then also how to kind of modify those indicators depending on our perspective and objective. Okay, and I'll explain that in a moment. So we want results quicker. We don't want to spend all day looking at chart after chart after chart, right? We want to be able to get results much quicker. Over the years, we felt, we feel that market direction is the single most important thing that you need to understand and recognize every single day. That is going to determine whether you're bullish on the market, you're bearish on the market, or sometimes you're neutral on the market. Okay, there comes times where you're not buying any stocks for a while. Maybe the market is moving sideways, right? You need to recognize that. You need to learn how to recognize a sideways market, a channeling market, and then those situations that I love where the market you're going to think this is weird, where the market gets crushed, right? And we enter into kind of the buying opportunity of a lifetime, very similar to 2020 in March. There are certain times, doesn't happen all that often, but there are certain situations where the market will hit an extremely oversold situation. Okay. So what we want to focus on is 3 areas first: when, what, and how. The when is, what is the market doing? When should I be placing trades? Should I be bullish? Should I be bearish? Should I be neutral? So that's the first thing. What is the market doing? And then once we recognize that, what is the appropriate technique to use in that type of market environment? And then how am I going to find my trades? Okay, how am I going to find my trades? A few folks are saying the volume is an issue. Are you guys having issues with the volume? Just type in quickly yes. Yeah, I mean, if you're having issues with volume, you can't hear what I'm saying right now. But if you can hear me, just, okay, VJ says no, so that means not having any issues. Okay, Mary says no issues, so that must be a lot of no's. Volume is good, loud and clear. Unfortunately, that's local to certain folks' computer, if you guys can hear me. Okay, so let's talk about the when. The market can do 3 things. It's going to do one of 3 things. It's going to trend. We love this type of market, right? Everybody loves this type of market. Market's hitting higher highs and higher lows. Traders love it because they're buying the dips. Investors love it because it's just a nice smooth ride, not a ton of volatility. Then there comes a time where the market no longer trends. It's not trending up, it's not trending down, it's moving sideways. It's known as a trader's market. Okay, known as a trader's market. Investors don't like this type of market because if you're an investor, kind of a buy and hold, of course you're going to have some money management rules in place, but if you want to buy stocks for years, multiple months, 6 months to a year is your objective. A period of 4 to 5 months of the market moving nowhere and you not making any money is not fun. But traders, they kind of welcome that situation because they're able to be quick in and out as the market bounces back and forth between the support and resistance levels that the market is trading in. Okay? And then there's situations like March of 2020, like December of 2018. There are certain situations that come up where the market just gets hit really hard for an extended period of time, and it hits an extremely oversold price situation. Now, there are a lot of indicators to help us identify oversold price situations, RSI, stochastics, to name two. But we have, within the VectorVest program, we have some proprietary market analysis indicators that help us identify when the market is in an extremely oversold, ripe for the taking type of market. So here's what a trending market looks like. Okay, here's what a trending market looks like. Now, this is February of 2017 to February of 2018. Don't worry about the time frame. It's the picture here that we want to kind of take a mental snapshot of it and understand what this looks like. Understand what type of market this is. This is a trending market. This is a market that hits higher highs and higher lows. Okay, almost, bi-quarterly. Right? Higher highs and higher lows. Investors love it because they're riding the long-term wave here. An investor is going to do that, right? Traders, which I am, and kind of what I'm, looking to kind of teach you guys a little bit about today, is that we want to buy the dips. We want to look. We're going to take advantage of this uptrend, and we are going to be bullish only. Meaning, I want to buy at the dips. And there are reversal signals here that I'm not going to go into today, but just kind of as a general rule, we want to buy the dips, and we want to get defensive after new swing highs and subsequent, retreats occur. Get defensive. Tighten up your stop criteria. Take profits, why not, right? But we're not bearish. In an uptrending market, this is very important. In an uptrending market, we are bullish only. We are bullish or neutral. Neutral is when the market does pull back off of a new high, right? We're still in this higher high, higher low trend, but the market's pulling back off of a new high, and we are not buying stocks during the pullback. That's neutral. You're letting your stop criteria take you out, or you're tightening up your stops, but you're just not replacing those positions that you exit out of during these little pullbacks, because you're in an overall uptrend. If we were in an overall downtrend, just picture the opposite. Here's my cursor. This is your downtrend. I'm not going to be bullish during those dead cat bounces. Now, I know you're saying, well, how do you know it's going to be a dead cat bounce? You don't 100% know, but you're in a downtrend. So those rallies are generally shorter lived, and the retreats, the pullbacks are generally longer, just like the opposite of an uptrend here. The rallies are longer, the pullbacks are shorter. That's why you're in an uptrend. So I'm just going to speak about being bullish here. In an uptrending market, a lot of people don't short. It's okay. But in an uptrending market, this is what it looks like, first of all. So if you're looking at it, and we'll look at the market as of right now, and we'll determine what we're in. But this is just a historical snapshot of what an uptrending market looks like and how we want to play it. Then, this is now January of 2018 to August of 2018. So this was 2017. Hard right edge here is January of 2018. Left edge is now January of 18, and the hard right edge is August of 18. This is not a trending market anymore, right? How do I know that? Well, here, okay, so here was the recent high. Boy, big pullback, rally. That failure there and subsequent pullback leads me to see here that the uptrend is over. We're not hitting higher highs anymore. But what's also not happening? We're not hitting lower lows either. Okay, that's not a higher high. That's not a lower low. We're just moving sideways. That's not a higher high. You could see what we're doing here. We're just moving sideways. If we were, up here, pull back, another new high, that's an uptrend. We saw that on the previous chart. So in this type of situation, investors hate it. Look, if you're holding here From here to here, you're hardly making any money, and that's an 8-month period of time. That stinks for the investor, but for traders, we don't mind it. We'll play the market off of support, and we'll play the market off of resistance. We'll buy at support, we'll sell at resistance. We'll short at resistance, we'll cover at support. That's what traders do in these types of markets. So this is what a sideways market looks like. The reason why I'm emphasizing this, because in a moment you're going to see that in each type of market, and the next market is the extreme situation. In each type of market, there are certain indicators that are ideally suited for that type of an environment. We'll get there in a second. I'll explain more about that. But it's important that you recognize what type of market you're in, because if you don't recognize what type of market you're in and use the wrong indicator, it's going to blow up. It's going to blow up on you. Okay? So this is what an extreme market looks like, extreme situation. Here we're looking at November of 18, October of 18, November of 18, December of 18. Market now is in a downtrend, right? Lower highs, lower lows, and it finally bottoms out at the end of December, right after Christmas, if you guys remember that. 26th of December was that big green candle there off of the bottom. Two of our market timing indicators, one called the MTI, the other called a buy to sell ratio. MTI is on a 0 to 2 scale. Buy to sell ratio is a ratio, so it's not on any scale. But when we see that the MTI goes below a level of 0.60, by the way, the MTI identifies the underlying trend, the longer term trend of the market. When the MTI goes below 0.60 and the buy to sell ratio goes below 0.20, buy to sell ratio is an indicator that looks at how many stocks in our database are getting buy ratings compared to how many stocks are getting sell ratings. That ratio helps us identify strength or weakness in the market. So with a BSR of less than 0.2, you have 5 sell rated stocks to every 1 buy. That's an anemic market. That's a market that is just itching to rally. A lot of bargains out there, right? When you have so many stocks in downtrends. Now, just because these indicators get to below those levels doesn't mean that we're running out and buying stocks yet. But it's what you want to recognize to say, oh boy, this is a really oversold market. You can look back historically too. Once you get into the VectorVest program, you could look back historically and see every time the MTI got to below 0.6 and the buy to sell ratio got to below 0.2, what did the market do? Most times, either imminently or not too long after those indicators get to below those levels, you get a rally. You get a really sharp rally. And we got that right after Christmas when those indicators got to below those levels. Okay? Incidentally, I talked about reversal signals at the dips during those uptrends. This is a one white soldier pattern. This is a bullish candlestick reversal signal that nailed that bottom. Nailed the bottom. You got follow through the next day, and there you were off and running. Okay, so those are the 3 types of market environments that you will encounter. A trending market, where you're looking at high. If you're looking at the hard right edge, you're either at a new high, or coming off of a new high, or creating a higher low. Kind of developing a higher low. So if you're recognizing those things in real time, then you know, okay, I'm in a trending market. If you don't see higher highs, but you're not seeing lower lows, you're likely in a trader's market. And then when you see that MTI go below 0.60, buy to sell ratio go below 0.20, you are in an extremely oversold situation. Get ready to start buying stocks when you see a rally. The indicators that we are going to use, and I'm going to teach you here today, there are going to be 3 indicators. We're going to talk about the MACD for trending markets. The MACD stands for Moving Average Convergence Divergence. It has the 2 words moving average in it. And moving averages are trend indicators. They're technical indicators that identify trend. They could identify a weakening trend, emerging trend, strengthening trend, just depending on how you use moving averages. But the MACD, because it's based on moving averages, doesn't it just make sense that you would use that type of an indicator in a trending environment, in a market that's trending? Okay. Okay, good question. You're discussing oversold market. What is the opposite in the buy to sell ratio and the MTI overbought market? There is no top level for the buy to sell ratio, but the MTI, it's 1.5, 1.6. that is a level where we kind of search for a maybe sometimes a temporary top, but we tend to see weakness when the MTI gets to that 1.5, 1.6 level. So the next indicator that we're going to talk about is support and resistance. This is going to be an indicator that we use in a sideways market. So for example, if you're recognizing that the market is no longer trending and it is moving sideways and it has just recently pulled back to a support level, to the same level that it stopped at, let's say 1 or 2 times prior, and then you see a retracement off of that support level, just a classic move, classic retracement off of support, and you're thinking, I'm a trader now, I'm going to get back into the market. I'm going to start looking for stocks, right? So a support retracement is a bullish situation. So why not look for stocks that are also retracing from their own support levels? There's ways to do that within the VectorVest program. And then finally, when you see that MTI below 0.6, you see the buy to sell ratio below 0.2, and then you see a rally, the stochastics oscillator is a great indicator to use in those types of situations. Stochastics identifies overbought or oversold and oversold price situations. So I want to look for stocks that are oversold in a market that's oversold that is now breaking out. Okay? All right. So the slides, guys, I'm going to hop into the program now. All right. I've set up my charts the same way that the slides are reading here. And again, you'll get these slides, after we're done. Okay. So this is a chart of NVIDIA from March of 2020. Follow my cursor here. March of 2020 to about February of 2020. And this is a daily chart. I'm going to teach you guys how to use the MACD on both daily and weekly charts. And I'm going to show you the difference, and then you determine which frequency you want to use. I'm going to kind of go through the pros and cons of both. So let's just look in this area here. This is a daily chart. Okay, daily chart, daily price bars, price at the top, MACD at the bottom. So on March 25th of 2020, now what I want you guys I want your eyes to gravitate to a few places. One, the date line, and two, the value of the histogram at the bottom right here. And those are really the two places. Well, because watch when I pull my bar over, you can see it changes the value of the histogram. So just kind of go back and forth, and as I move my date line, you can see the value of the histogram change. So on this day, March 25th, it went from negative to positive. This is a daily chart, okay? And that was a nice entry. It didn't turn negative, so you would have stayed in. If you're using the MACD, again, MACD stands for Moving Average Convergence Divergence. Just a simple application of the indicator is you buy when the histogram bars go from below 0 to above 0, and you sell when the histogram bars go from above 0 to below 0. Okay? But what I want you to focus on is the type of price environment that you're in. Type of price environment that you're in. What type of price environment is this? That's an uptrend. I'm staying in. The MACD histogram bars stay positive. Well, dips negative here for a couple of days, so I have to get out. I didn't know that the stock was going to continue to rally after that. But I got in on a bullish MACD crossover. On an end of day basis, I got out on a bearish MACD crossover. I can always get right back in when the histogram changes again. If I got whipsawed, and that happens, guys, a lot of times when you are, when you use daily charts, you get whipsawed sometimes, right? No indicator is perfect every single time, but you're able to get back in here, and then you rode that nice wave up a little higher, and you exited here. The MACD histogram stayed negative this entire time, and I find that weird in this case because the stock price actually rises a little bit. So that's called a bearish divergence. It's called a bearish divergence. Price rising, but your indicator is falling or negative. That's a bearish divergence. Now, not all bearish divergences play out where price then corrects or pulls back after that divergence kind of plays itself out. It's just letting us know that is not a very weak, a very strong move right there. okay? But you followed the rules and you stayed out during that time. But you're able to get back in here when the histogram turns positive, and then you rode that little wave up, and you got out there, small little gain. So we've traded in and out of this trend, guys, a number of times, right? One, got back in two, got out three, got back in four, got out five. Traded back and forth about 5 times. And now we're on to our 6th time because we're looking at this crossover here, this bullish crossover. Now that's the move that we hope for, right? We hate to get whipsawed out, but you just don't know, guys. When you're pulling back off of a new high, you don't know how long that's going to last, right? How severe that pullback's going to be. Your indicator tells you to sell, so you sell. Okay? Always able to get back in if the indicator changes direction. But here is the one, right? Here's the big trend that you hope for when you follow the indicator. So here we get back in August, we sell, beautiful, right here, a couple of days off of that top in September of 2020. Okay? What I want to show you now is a weekly chart of NVIDIA over the same time frame. Basically, we're looking at January of 2020 to February of 2021, basically the same time frame. But now we're looking at a weekly chart. So my date line here is April 20th of 2020, and that's when the weekly MACD turned positive. Notice, that's about a month after the daily chart turned positive, right? March 25th was when our daily MACD turned bullish. April 20th was when the weekly MACD turned bullish, a whole month. So we missed out on some of the early move during this time period. But using a weekly chart and following a weekly MACD, we didn't get an exit signal until October. The first exit signal that we got wasn't until October. So we're using the same methodology of using the MACD in that we want to identify changes in trend. You go from identifying a change in a daily trend and getting in earlier. However, what are you more susceptible to along the way? You're more susceptible to more trading because of the little whipsaws that you might get along the way in this big trend. Okay, so you might be saying, I like getting in earlier. Well, if you like getting in earlier, then what you may want to do is use the daily MACD to enter and then the weekly MACD to manage. Does that make sense to everybody? If you want to get in earlier, if you're someone that says, I like that, kind of that first early signal off of a bottom using the MACD, then you use the daily MACD. But then as you go, you start to see that trend emerge and get stronger. Right now we're here at the end of April. Well, look at that. When was our crossover? The same time, right at the end of April, our bullish crossover. So instead of managing the position where you're now using the daily MACD to manage, because again, I just showed you that it's going to result in a lot more trading. Okay, you can flip and use the weekly MACD to manage your position. So now on October 26th, what I love too is the time during this period of time, which is this period of time. Now we're not in a trending market anymore, are we? How do I know? Okay, so this is the new high. So I told you I'm going to explain the importance of using the right indicator in the right market. So now, ready? Higher high, higher high, higher high, higher high, higher high, higher low along the way, higher high. Uh-oh, okay, so pull back. Not quite a lower low. Little rally, failed. Pull back, higher low. Rally, failed. You're no longer in an uptrend. Can you guys see that? Everybody can see that? So abandon the MACD. Why? Because in a sideways market, look at how maddening this is. In a sideways market, and this is a 4-month period of time here, look at how many false or unsuccessful signals you'll get. You'll get. You get a bullish signal, bearish, bullish, bearish, bullish for a couple of days, bearish. It'll drive you crazy. It'll drive you crazy. So use a moving average or a trending indicator in a trending market. Okay, in a trending market. Now also, when did the bearish MACD happen? October 26th. That was when the weekly bearish MACD crossed into bearish territory. Really here as well, right there. We'll say November 9th. Okay, that is when the weekly MACD turned bearish. And look at the weekly MACD for the next 7 months or so. Stayed bearish. 7 months, weekly MACD stayed bearish, while the daily MACD during that same time period flip-flopped back and forth, back and forth. So use both a weekly and a daily chart to help identify entries and exits. And then also when let's say a weekly MACD is bearish, you know that is not a good time to be long that position. Okay, let's look at another example. Here's MU. We're looking at the last 2 years of MU. Okay, end of day. This is a daily chart. And I'm just going to focus really on this kind of area right here. August 21 of 2020 to September 8th of 2021, almost a year. Here's my weekly chart. Okay, what did I say? August of 2020. Stop right there. We'll stop right there. So with a daily chart, we could look at this crossover here in August. Let's go back here. This was your kind of a first initial crossover, bullish, bearish cross, you exit. Bullish cross, you're coming off of another higher low, you enter. Bearish cross, you exit. You're coming off of another higher high. Bullish cross, you enter back in, another new higher low. You see that trend there. So you're getting in and out, you're kind of playing the little waves, the mini waves, the ripples within an underlying long-term move. Okay, so you're trading in and out, but you're catching the moves earlier. Okay, whereas a weekly chart, you get in once on September 14th and you get out on April 12th. That is where the weekly chart broke down and turned bearish on April 12th. Okay, okay, ready? Higher high, higher high, higher high. Barely, tough. No, not a higher high. Actually, you know what? Nope, not a higher high. There's the high. Okay, yes, we hit a higher high, but this was a lower low than this one. And now we're just breaking down. Now we're just breaking down. We're definitely not in an uptrend anymore. Abandon the MACD. If you start to see yourself in a downtrend and no longer hitting higher highs and higher lows, abandon the MACD. How can you confirm that you should not take this bullish signal here in May of 2020? How can you confirm that? You think this is it, this is the bottom, I'm catching it, the stock is going to go right back up. How can you confirm that you shouldn't take that May 24th bullish trade? Go to a weekly chart. And right there was May 24th. We're in a weekly downtrend. So don't take the bullish trades in a downtrend. Why? Look at those rallies, guys. They're really short-lived. They're really short-lived. Okay, I don't mind using the MACD, and you have to understand your objective here. The MACD, and I'm going to show you an indicator here in a moment that catches bottoms a little bit better than the MACD. Remember, even a daily MACD, it requires a meaningful change in trend. So I'm not looking to catch the bottoms here using the MACD. So here you're saying, if I would have got in hit there was the big one, right? Because now this is the hard right edge now. This is the current date, November 12th, and we're moving. What is the weekly MACD telling us as of right now? It's telling us that now's the time. You could see that it just turned bullish. The weekly MACD just turned bullish. We're about 2, 3 weeks or 4 weeks off of the bottom. That's okay. That's okay. If you're using the MACD, don't expect to or strive to catch every single bottom. It's to identify these longer term moves. Okay? Very easy application of the MACD. Look at the weekly and the daily charts. Okay? Weekly and the daily charts, it's going to help you manage the trade so much better. All right, next indicator. So just to recap. Focus on using the MACD on both a daily chart and a weekly chart, kind of looking at them both, when the market is trending higher. When the market is trending higher. Okay? If you start to use the MACD in this type of an environment, we're looking at AMD now, and this is the last 2 years of AMD. If you start to use the MACD in this type of an environment, you know, September of 2020 to July of 2021, boy, that's September, July, August, that's 10 months. Mary says, do you do the same with options? You can do the same exact thing with options. Well, I'm just talking about trading the stock, but you know, you can apply options to it as well. There's so many more variables to it. I'm not going to get into them, but if you're bullish on the stock, you're going to place a bullish option trade, right? Just depend on what trade you're comfortable with. So this is a 10-month period of time here where this stock moves sideways. Investors don't like this. But if you're a trader, what you're able to do is play the retracements off of support and the retracements off of resistance. So you could have traded this one in and out once, twice, probably would have gotten in somewhere here 3 times. The stock rallied for a couple of weeks. Remember, we're looking at a weekly chart, and then it came right back to retest that support level that you just bought off of. Price did not reach resistance, which would have given you an opportunity to take action, to take money off the table, to tighten your stop. It didn't reach resistance. It almost not too long after you entered. I mean, you probably entered right in this area here. That's that nice clear retracement off of support. A couple of weeks later, the stock retested that support level. So how do you manage the trade? You get in, and what happens? Oh, I got in, and immediately the stock goes down. You've been there before? I have. That happens. A lot of times we panic sell. We say, I don't want to take too much of a loss, so I'll exit. What we're doing here is we're reading the chart. We're understanding these key support levels so that we can manage the trade a little bit better, because why exit at support, right? Why exit at a level? Look at the circles there, and you could probably get a couple of more in there. Why exit at a level where price has stopped multiple times in the past? If it breaks down through support, I get it. You want to exit, you cut your position, because then if it does, you're probably, you're not looking at the next support level as the next potential floor. Okay? But we buy off of support, we're bullish off of support, and we are bearish at resistance, or not necessarily at resistance. We are bearish when price retraces from resistance. Okay? We buy off of support, we sell off of resistance. Now then there's going to come a time where you enter off of support. You get a little scared here, a little concerned because price retested that support level, but then you get that nice retracement. And look at that. Look at that week. July 26th, week ending July 26th. You get a blast out, a blast up through that resistance level. Okay? Blast up through resistance. That's also bullish. If you didn't take the trade off of support and you see price breaking through a resistance level, that's also bullish. That's telling you, okay, You know, that the buying pressure now is overcoming the selling pressure that occurred at that resistance level multiple times, right? That's why it's resistance, because selling pressure overcomes buying pressure. Buying pressure overcame selling pressure and the stock breaks out through resistance. So you enter, you know, the end of that week, the beginning of the next week, if you want to wait for confirmation, which I think you should. So then you enter in on the following week, you know, right the next Monday, and the stock breaks out beautifully, hits a high of 122.49 that week. But then it closes, boy, all the way down to 110. You could have taken profits. If you didn't, you're either using the next resistance level, and there is none with AMD because we're looking at new highs here, or the retracement. What happens a lot when you get a breakout through resistance? Well, that resistance level becomes support. So a lot of times you'll get the breakout above resistance, but then you'll get a pretty immediate sometimes retest of that support level. And look at that. Look at where it stopped. Look at where the retreat stopped. It stopped at the same level that it stopped back here, right? And then a retracement off of that level and blasting off now. Blasting off now. So there are a couple of ways to trade this. You can trade the breakout of resistance. You can also trade the retest of support. You can also so if you wanted to buy more of the stock, you can do so if price retests support and then retraces from it. You can buy more of it. That's a nice bullish move there. Okay. Here's AOS, another S&P stock. Same situation. So here, let's kind of pull this back a little bit. Here's the hard right edge. You can almost extend this line out because it's going to look at this most recent high too as resistance. But you get this resistance level where price is having a hard time breaking above that, right? You get a hard time breaking above it. I'm not going to trade a stock. I'm not going to go long so close to resistance. Okay? I look for the breakout, and there you got it. There you got the breakout above that resistance level. So that, and again, we're looking at a weekly chart. So now I'm looking to trade it, and there's that breakout. You kind of got a little mini retest of it too, didn't you? After the stock broke out of resistance, you got a little mini retest, little hesitation, little pullback, settled back into that, what is that, 59.03 zone, and then you get another retracement off of it. So you can, again, either play the breakout or play the retracement back towards that support level. So now we rise, we rise, we rise. Okay. I wouldn't blame you if you took profits somewhere in this area, guys. Remember where we're entering in? Roughly a price of 60 bucks. It hit 67. Nice 10% gain there in about a month. Okay. Now it hits a new high and it establishes a new resistance level. So if you didn't take profits here, you're really starting to take profits now as it reaches the resistance level there. Okay, a couple of touches right in that zone, and then we get a retreat, and you're out. Another retest. Another retest. Look at that. Retracement, crash. Having a hard time breaking above that 73.43 zone. We come all the way back down to support now. 59.03. Remember, it was resistance. Now it's support. We get a touch in that zone on the week ending September 27th. Nice retracement. Nice retracement, and then we're back in. We're back in. The week ending October 25th, we reach resistance again, but I'm not going to just close the position because price reaches resistance, right? Give it a chance to break through. Eventually, something's got to give. If you have a period of time here where that selling pressure is just winning, 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 something's got to give. The bears are going to give up, the bulls are going to regain control, and you're going to get a really nice breakout above that resistance level, and that's what we're seeing here now. Okay, last support and resistance, D.H. Horton, great builder, great builder. So here you had a level of support right at about 64.55, rally, retest, stopped at the most recent high. That is your support level. rally, new high, good, that's encouraging. But then you get a retreat, and we don't make a new low, but we don't make a higher low either. Rally, retreat, now we're stuck. The floor is holding, thank goodness. The floor is holding, $64.55. We get a rally, uh-oh. Cannot seem to break above that $82.19 zone. Couple of week retreat, and then blast off. Then we rocket through there. Don't forget this 82.19 level though. It was resistance, but when you break above it, it creates support. You get that rally, you get the retest. Where does it stop? Right at support again. Rally, retest, rally. So this is the hard right edge. So boy, a couple of weeks ago, about a month ago, would have been a perfect entry off of this successful retest of that 82.19 zone. Okay. And then finally, actually, we'll look at the last indicator, stochastics. I love this indicator. Stochastics is my favorite technical analysis indicator. It's on a 0 to 100 scale. When it's below 20, it's considered oversold. When it's above 80, it's considered overbought. I'm just going to focus on, and we're looking at a daily chart here. We're not looking at a weekly chart, looking at a daily chart over the last 1 year. I'm only going to focus on the buying opportunities, right? The bullish situations. The situations when the stochastics oscillator goes from below 20, and that's the red line here, from below 20 to above 20, buying opportunity. Good entry there, right? Below 20 to above 20, buying opportunity, another good entry. Notice what the stock is doing here. It's trending. So I said that you should only use the MACD in a trending market, and you should. You can mix and match other indicators. I love using stochastics in an uptrending market because it does such a good job of identifying the dips, of identifying the oversold, short-term oversold price situations within an underlying uptrend. This is an underlying uptrend, higher highs and higher lows, but look, we're going to get those dips. We're going to get those new lows put in, higher lows put in. And then a stochastics oscillator, when it crosses from below 20 to above 20, is giving you a signal to enter back in. It's a signal. It's a signal. Okay? Even works good in a sideways market. There's your bullish crossover. You had an opportunity to make money. Where did the stock stop? Where did it stop? Right at resistance. What did it do? Kind of pulled back, hung out, resistance, pulled back a little bit. You exit the trade. Mix and match. You could start mixing and matching indicators to help you manage trades. If you get in on a stochastics bullish crossover and you see price approach and then retrace from resistance, what do we know about what to do with that position? Stochastics is 14.3 slow, Ryan. 14.3 slow. Okay? Then you get another situation here where stochastics goes from below 20 to above 20. You hope after you enter the trade that price breaks out through that $144 resistance zone. It didn't though. It hit it again and retraced from it. You get stochastics now going from below 20 to above 20. There's your entry again. So it works really good in a sideways market. Okay? There's your entry. Price reaches resistance again. Are you kidding me? That's like the 5th time. Retrace from it, you get out. Okay? Now we have another stochastics crossover here. We're looking at the hard right edge just a month ago, October. Price got to resistance, and then here we finally got the breakout through resistance. Finally. Okay. So let me hop back in. Give me 1 second here. So very easy application to use stochastics. So the question now becomes, how am I going to find my trades? Tom's asking, how do I identify support and resistance? Okay, there are 3 methods. There's the 1-by-1 method where you have to right away, no other options, look at the charts. Look at the charts. Look at the charts for a daily MACD crossover or a weekly MACD crossover. Look at the charts for support and resistance on a daily or weekly chart. And then look for stochastics as well. Crossing from below 20 to above 20. You could do that on a daily or weekly chart as well. Okay? My preferred method is to use a search, a scan. Okay? that'll help you filter down a very large list of stocks to meet stocks hitting a certain criteria. Then what I'll do is then I'll open up the charts. Once I'm able to kind of whittle my list down from thousands to maybe 100 or 50 based on the criteria that I'm using, then I'll look at the charts to look for maybe better candidates, right? I'll cherry pick, and this is more of an art form than a science when it comes to cherry picking. But I'll look at the charts after that. And then the final method is kind of the fastest. It's getting automatic alerts. So using a list is simple. Any list of stocks. We're looking at the S&P 500 list. Okay. So what I would do is I'd open up the charts of all 500 stocks, and that's just one list that I'm kind of using here as an example. And then I'll look at the hard right edge. I'll throw MACD. If I'm in a trending market, I'll throw MACD on, right? Because if I'm in a sideways market, let me understand first what the market's doing. So I'm going to look at the list of stocks, yes, but I have to recognize what the market's doing first. Let's say the market is retracing from support. It's not trending. I'm going to open up these charts, and I'm not going to look for a MACD crossover because the market isn't trending. It's channeling. So I'll put on support and resistance, or I'll put on stochastics. And as of the hard right edge, I'll see, okay, does MU have a stochastics crossover today? No, move to the next one. Does Lam Research have a stochastics crossover today? No, move on to the next one. And you have to kind of go through the charts one by one. My preferred method is to use a scan. This is going to help you tremendously get to where you want to get to. Within our VectorVest Premium program, we have a tool called Pro Trader. It's a technical analysis tool. It allows us to search for a lot of different technical indicator situations, whether it be crossovers or retracements or anything like that. So we have scans that look for stochastics crossovers, crossing from below 20 to above 20. You can modify the search as well. If you're bearish on the market and you want to look for stocks to short, you'd look for a stochastics crossing from above 80 to below 80. So there are searches in the Pro Trader tool that help you find these types of situations. We also have support and resistance searches, and the searches will find all 4 support and resistance situations. What are the 4? Retracing from support or breaking resistance, both of those are bullish, or retracing from resistance or breaking support, both of those are bearish. You can find all 4 of those just depending on what the market's doing. So if the market, let's say, is retracing from resistance and you want to find stocks to short, you would look for stocks that are retracing from resistance. And then finally, the MACD. Okay, you can use the MACD to search for MACD crossovers. Now, you can only search for daily crossovers, meaning the daily MACD crossing bullish on a given day. But you can then look at, that's why I said before, when you run the scans, that'll get you most of the way there, and then you just look at the charts and you just scan through the charts to see which ones have recently had a weekly crossover or just about to have a weekly crossover or is having a weekly crossover on that current week. So you just got to look at the charts really quick. Then the final tool that we have within the VectorVest Premium program is called a Watchdog. This is automatic alerts. You set up the Watchdog once. So I've highlighted here, I have a bullish MACD crossover on the S&P 500 watch list. And you can see the alerts that I got yesterday. This is just a screenshot, but I'm constantly getting alerts. At 11:52, DFS met the criteria of a bullish MACD crossover. 2 minutes before that, OMC met the criteria of a bullish MACD crossover. So I'm getting these alerts all the time, and if I'm ready to trade, sometimes I'll unsubscribe to it, where I don't want to get alerts. But if I'm subscribed to it, that means the market's trending up. I can also look for support and resistance situations here as well, depending on the market. I get real-time alerts to my cell phone, to my email address, just depending on how I have it set up. So how much time would this save you? Think about it. If you're someone that does the one-by-one method and doesn't have any method of scanning for stocks, using the Pro Trader tool within the VectorVest Premium program and or the Watchdog will save you a tremendous amount of time. So I'm going to take a few guesses as to why you guys showed up today. You showed up today because you wanted to learn how to effectively use popular technical indicators in your trading. You wanted to see how you could easily search for stocks meeting those technical patterns, and maybe you wanted to see how VectorVest can alert you of these possible trades. So what you learned today is to match the market to your indicator. That's really the main thing I want you guys to take away. Don't use or try to use the MACD in a channeling market, and you will see. You will see how it fails you more times than it succeeds. So match I'm going to flip that around. Match the indicator to your market. Know what the market's doing, and then use the appropriate indicator in that type of market situation. Effectively use popular technical indicators. That's what you learned today. How to use the MACD, how to use support and resistance, how to use stochastics on both the daily and weekly time frame. And then how to quickly and easily find trading opportunities. So the big lesson, technical analysis can help anticipate, there's that word again, anticipate future direction, and you can find some great trading opportunities, especially if you use the power of speed. So you might be asking, good stuff, how can I get started using this type of an approach to mix and match and look at different time frames when using these indicators, and then having the ability to scan for them quickly? You have a choice. You could do it the fast way, the slow way. What's the slow way? The slow way is the one-by-one method, looking at chart after chart, and then you're doing that from scratch. There's no way to speed that up at all. You can do it the fast way, which is using a scan, a search that finds stocks that meet specific criteria. You can also use tools that give you automatic alerts as well. So that's why our VectorVest Premium program includes all of those things. It includes technical and fundamental charting. It includes market trend signals, scans that help you easily find trading candidates. And it also comes with automatic trading systems, automated trading systems and alerts as well. Now we sell this package, and you get also real-time streaming data for the US market. We sell this for $149 a month, but I want to invite you guys, special offer for those of you that do not have the VectorVest Premium program, whether you're a VectorVest subscriber and maybe subscribe to the end of day data or the intraday data, or you're not a VectorVest subscriber at all. $9.95 for 30 days, and you get to try out everything that I just went through, all the different technical features and scanning tools that the program has. So what I'm going to do, I'm going to type that address that you guys see at the bottom, www.vectorvest.com/ this is a long one, capture trades. Make sure I typed it in right. Yep. Okay, so I typed it in the chat box. You guys can just go ahead and click on it, and that will bring you to the order page. I'm going to give you guys a special bonus as well. This is a stock buying checklist. Okay, this trial is good through the weekend. I believe the trial ends on Tuesday. If you order before Tuesday, the special $9.95 trial to the VectorVest Premium program, I'm going to throw in this checklist. This is great for those of you that like to be a little bit more hands-on with your trades. You like to write down what stock you bought, when you bought it, why you bought it, what's your stop, what indicator did you use, what's the market doing. So it's a nice checklist to follow. So I'm going to give this to you guys if you order the trial before Tuesday. It's also 30-day money-back guarantee. It's $9.95. If at the end of the 30 days you say, you know, I want to go back to my end-of-day service or my intraday service, just let us know. We'll give you the $9.95 back. No questions asked. So the special offer again, guys, $9.95 for 30 days. You get everything that I went through today, plus a whole lot more. All right. Oh, nobody reminded me. So what I'm going to do now is I'm going to put the slides in the handout section of your GoToMeeting control panel, and I'm also going to send them to the folks that will be able to email you or send you folks that are joining us via YouTube those slides as well. Okay. Question is, how do we manage position risk using these technicals? I've kind of just gone through that. Using resistance to sell. MACD bearish crossovers, you exit, right? So if you enter in on a support retracement and you were fortunate enough for price to reach resistance and then retrace from it, you exit the position. So you're using the indicators to not only help you enter but exit as well. If you get in a stochastics crossover from below 20 to above 20, and you're fortunate enough where stochastics reaches 80, you got a nice gain up there. Stochastics goes from above 80 to below 80. Those are signals to sell as well. So you use the indicators to buy and sell. All right. All right, guys, have a great weekend. Really look forward to working with you folks. This $9.95 trial good till next Tuesday. We'll give you that stock buying checklist as well. But if you have any questions, you can email me. My email address is jerryd@vectorvest.com. Okay, jerryd@vectorvest.com. If you have any questions, feel free to email me. You're very welcome, guys. You guys have a great weekend, and we'll see everybody again soon. Take care, folks.